Welcome to Money Matters with Matt and Rich, episode 28 today.
Yes.
Hey, Matt, how are you?
Great. Just got back from vacation.
Yeah,
so
well, I was going
great.
to say. Welcome back from Mexico.
Yeah, we went on a little President's Club trip. Boss took us on a 6-day little trip to Mexico down to Riviera Maya, so it was good. It was the appropriate amount of time. We'll just put it that way. I think it was.
Yeah, that doesn't suck.
No,
that's great.
No, especially when it was negative 30 here. It was perfect timing, actually.
Yep, don't rub it in.
No, it was like, I think we saw at the time, it was like 122 degree difference between where we were and where it was up here. And we were like, oh, that sucks.
Nice to be gone. As long as your house didn't have any burst pipes.
No, actually, we had our, Michelle's dad came one day, or both days, actually. I think he came both days on Friday and Saturday to make sure he actually started the car, is like making sure everything's good, because we were stressed about that. So, I mean, it must have felt cold. I can't imagine it was comfortable.
Yeah, no, it was not comfortable. It was very cold.
Yeah.
Very cold. A lot of burst pipes. Luckily, nothing on our end, any of the properties or our house. So
nice.
We made it through this one unscathed.
Yeah.
Fantastic.
That's awesome. That's awesome. But yeah, I'm glad to be back. Let's just say that.
Awesome. Well, hey, we want to remind people to, if you find value in this, subscribe on the, hit the bell on the YouTube channel, share this with friends, family.
Yeah.
If there's any comments that you have, anything that you want to see us talk about or go over or maybe shut up about, whatever you want, let us know, leave a comment, and we will get to it. Other than that, we've got I think a great conversation today about FHA multifamily buyers.
Yes. Yep. There's a lot happening with them that are making them very difficult, even for well-qualified, possibly even cash flowing properties once you move in. It's something called FHA self-sufficiency. And a lot of people don't know about this. I don't see it a lot on those goddamn TikToks or
nobody's talking about this.
Nobody talks about it, right? They just say buy the 4-unit, it's gonna cash flow,
no problem.
Use the rental income, you're good, right? But a lot of people are not aware of FHA self-sufficiency. And what that is every unit in the property they look at the market rent and the lease agreements that are currently on that property. So they're taking two numbers for each unit, even the one you're going to live in. Okay, so you're not getting, screwed on that. So if it's 4-unit, taking all 4, we look at the lower of the two, of the market rent and the lease agreement, add those up, hope you're still following me, and then we multiply that by 75% to account for any occupancy that will happen throughout any point in time.
Yeah.
That number has to be higher than your mortgage payment.
So I think what's important, to that conversation is, so the two items are what again? Market rent?
Market rent and
whatever's in the lease agreement.
Correct.
So market rent could be 3-bed, 1-bath in Manchester, nice unit, let's call it $1,800. That could be market rent, right?
Right.
The lease agreement, now someone selling a building probably has owned it for a little while, and they probably haven't raised the rents to post-COVID rents or COVID rents.
COVID rents even, yeah.
So they might still be at $900, $1,000 for a 3-bedroom.
Right.
And those are what's out there on the marketplace for the FHA and the underwriters to find. Because that's where they need to look. They need to look at on-market properties, correct?
Right.
So they're looking at on-market or sold properties.
Sold recently
properties, just like an appraisal. Sold recently properties and the market rents or the rents that they're getting, whether they're market or not.
Right.
So FHA buyers are getting screwed again by the frigging government.
Right.
Because back when interest rates were 3%, they couldn't buy a house. Now they can't buy a house because they're looking at market rents and they haven't adjusted to COVID rents or post-COVID rents.
Right. A lot of landlords haven't. And we're seeing that a ton in the Manchester, Nashua, really everywhere.
Most people selling, they didn't just buy it a year and a half ago or 2 years ago.
Yeah.
They bought it 5, 10, 15 years ago.
20, right.
That's just how it commonly happens.
Right.
Unless someone's doing a 1031 exchange, they just bought it in the last couple of years and did some work, whatever. But yeah. it's not working.
No, it's not. And we chalked it up when rates were at 7% to an interest rate problem because the mortgage payments were just too high.
Yep.
Right. And to an extent,
Rightfully
yes,
so.
that was happening. But we've now reached a point where FHAs, we're at like high fives, which is not a rate that should be stopping self-sufficiency. Right. When you approach 7, it's like, okay, rents can only keep up so much.
Right.
But when we're high fives, these properties that are say $400,000 for a 3-unit that are $3,000 a month, $3,100 a month on a payment, like the owner's going to cash flow that and possibly still live in a unit.
Yeah.
But because of those lease agreements, you could be a qualified buyer, income works, debt to income, your credit's fine, you have the money, but self-sufficiency says no, FHA won't fund it. There's nothing we can do about it.
And what I hate about that is, let's say an owner, a landlord, has increased the rents once they bought it to market rents, $1,800 for a 3-bedroom. It doesn't matter.
Right.
They're going with the lowest of whatever they find.
Right.
Which they're going to find $1,100, $1,300.
If you look for worst case scenario, you're going to find worst case.
There's a building I own that I will very likely be selling this year that I just bought, have rents at market value, but I know that I cannot choose an FHA buyer.
Right.
And it's nothing to do with the financing or the buyer. It's the sheer fact that I know it will not pass self-sufficiency test.
Right.
I already know that.
Right.
I've dealt with a buyer that had it happen. You've dealt with a buyer that's had it happen. It's happening.
Yeah. I'm 1 for 3 on FHA multifamilies in the last 2 months because of self-sufficiency.
1 for 3. Did that other person have to change financing? That one person?
No, we were like $20 over.
So you were able to get
it was airtight. Like we had to buy the rate down to make it work.
Yep.
Like, they had money. They had the assets to be able to do it. If they didn't have the extra assets to be able to do it, it wouldn't have worked.
So that's probably good to talk about. How can we get around that?
Right. So if we're close, there's ways to get around it. The only way to get around it is to lower your mortgage payment. And when taxes, insurance, and mortgage insurance are finalized, there's only one way to lower that mortgage payment, and it's to lower the interest rate. And you can buy the interest rate down, right? But if you don't have the funds, the capital to be able to do that.
So how much would someone need for a $400,000 property to buy it down from, let's just say it's at 6 to whatever would work, 5.5?
Yeah,
how low can they buy it down?
Right. So we can always buy it down about 2.25 points. The reason being is because including points and any other fees, we cannot be over 3% of the loan. So like underwriting fees, credit report fees, things like that cannot equal more than 3%, or the government won't buy it. So that way there's no predatory lending. You can't just charge somebody to charge them on the points. So let's say hypothetically we had to get down to like 5.5. Right now we're probably talking about a point, maybe a little bit under. The point system's a little weird now though, right? So people equate that, 1 point is 0.5%.
Yeah.
Not always. So we could go 1 point to go down to 5.5 from 6, but it may cost 0.5 point to go to 5.375 because the point system is structured very weird right now.
Yeah.
So it's not an all-in-one formula, but you're probably going to realistically need like probably another 2% of the loan amount if you want to make most self-sufficiency issues that we're seeing right now work.
So about a $400,000 house,
you need like $8,000.
Yeah, so each point is 1% of that sales price.
Yep.
So $8,000. Yeah, so do you have another $8,000 to make this work?
Right. Without tapping into reserves.
Right, because you need those.
Because you need them. Like, there's a lot moving here, and most people that are buying an FHA multi don't have another $8,000 just sitting around.
They're owner occupying.
Right.
Gift.
Right.
Gift funds.
Yeah,
borrow from
it's
your
a closing
dad.
Cost. You can do it. You can get a gift fund for that. Absolutely.
Borrow from your mom.
Right.
Borrow it from your brother.
Right.
Borrow it from your grandma, grandpa.
Right. It's so there's ways, but if it's just so far below, unless you got a very, very eager seller that is willing to drop that purchase price, it's just a hard stop. And I always feel bad for buyers because I know the property is going to cash flow.
Right.
I know it. I'm looking at it. I see it. I see what the market rents are. I get it. You're more than qualified. You're within debt to income ratios. You clearly have the credit score. We wouldn't have even gotten to the appraisal.
Yeah. And the property's going to make money once you move in.
Right. but we can't fund it because of it. And it's always the hardest conversation because like I feel for them. It's like, no, I know this. I get it. I get you're pissed. I 100% would be too, but there's nothing.
Can we post the phone number for the FHA people so everybody can start calling them and say, hey, this sucks.
Right. This is
like,
stupid.
Yeah. Like this is very stupid.
Right.
We should be going off of market rents, or at least a percentage point near it. Like, okay, maybe market rents, but we're going to adjust by 10% below.
Right.
Because that's potential. If the rents crash, that's feasible. But to say that $800, $900 a month for a 3-bedroom is what they're going to be renting for and what they're going to go off, that sucks.
It's ridiculous. And especially when I see anything below, even like $1,300, $1,400 a month now. I'm like, that's just not.
No, that's a 1-bedroom.
That's just, and there's not a ton of 1-bedrooms even out there right now, unless you're renting like an apartment complex. So like, there's just, it just doesn't make any sense. And it's unfortunate because, again, it's a hard stop. We can't like negotiate and go back and forth with underwriting because, yes, it's underwriting sending that message to us, but they're not the ones ultimately making that decision. It's FHA one above,
guidelines,
right? So we can all get mad. Right, but
I am. I am as a seller now. Strategy. What if? And maybe you know the answer, maybe you don't. But what if? Let's say that $400,000 property. Let's say we change the price to $408,000, paying $8,000 towards their closing costs to reduce their interest rate.
Right, that very well could work. Yeah. Like, so we can get creative on that end.
Strategy.
If you're willing to get creative on the financing, and again, it works. There's always ways around it.
You've got to get creative.
There's always ways around it.
Got to get creative. Like, if you're not thinking, here's, as you probably see and probably know, there's people that think, here's the box and it's inside. We're inside. If it doesn't fit in that, then we're done.
Yeah.
Sorry. So sad.
Yeah.
Which makes me think back to a transaction we had. Now that we're talking about this, maybe we could have done that.
Possible. No, we were too far below.
Too far?
We needed we needed down like $400, which on that loan amount wasn't going to happen. Yeah.
All right.
Yeah.
Well, all right.
Krista thought of that one. she.
Why didn't she tell me?
We exhausted everything to try to get that thing down.
Right.
But yeah, it's just. It's been very frustrating for buyers, for lenders, agents, sellers, because again, the sellers coming back to us and being like, you told us they were good. It's like, no,
they are.
The
government says
your
property
the house isn't good.
Yeah.
Right. And it's like, well, what does that mean? They're like, no, I don't.
Here you go. Send them this video, self-sufficiency, and what it is. Right?
Yeah, exactly. And again, this is only 3 to 4 unit buildings, not 2. Twos obviously aren't going to cash flow a ton. If anything at all, you're probably just doing that to lower your overall obligation on a mortgage, which is totally fine. But, for an example, I have one right now where buying a 3-unit, they're going to live in one of them. Obviously, it's FHA. They have to. The other 2 units, once he raises the rent to market, he's actually going to make money every month and live in the property for free.
And that's the idea. That's why we're always saying buy FHA, 3.5% down, 3 to 4 unit, and you're going to be a millionaire in 10 years if you do that once a year or every other year.
But guess what? It's probably not going to meet self-sufficiency.
So,
imagine that conversation. Yeah. Hey, you're going to make money every month on this property and live for free, but the FHA says that the property doesn't sustain itself. And it's like, what are you talking about?
Yeah.
It's like
it's just another. They're just shooting themselves in the foot.
Yeah. At the end of the day,
not the buyer or the seller, but like FHA and their guidelines.
Right.
There's got to be some. There's got to be some leniency there. It's got to be. Hey, what's the rent? They should go the higher of the 2, in my opinion. But who cares what I think?
Right.
And then go 10% below that.
Right.
Because that's a reasonable buffer to have if rents were to go down, which they don't ever go down.
But at least
they stay flat.
At least the FHA can make an argument. Well, what if they do? It's like, okay, whatever. I'll play your
build
game.
in a buffer.
But we'll play your game. Whatever. But at least we have that buffer in there. The other thing too, lease agreements, you can't argue. It's hard to argue that to underwriting. Market rent. So if the appraisal comes back, leases are matching what the market rent is showing, but the appraisal, when they go out and pull comps on it, if theirs is lower, we can send them the HUD fair market rent. What the FHA is saying that the fair market rent should be, we can send that to underwriting and be like, hey, appraisal's off here. What can we do about it? And there's room to negotiate that. Lease agreement, that's the number. Like, it's not like there's much that we can do to go back and forth. We can't create another lease agreement.
So you sellers out there are doing yourselves a disadvantage by not having increased your rents in a while, because you're now limiting the pool of buyers that may compete for your property and get you more money when they compete.
Right.
You're actually doing yourself a disservice.
And I think that's why multifamilies are sitting right now, to be quite honest with you, is because...
Are you seeing them sitting?
We are, yeah. I've seen them sat.
We're looking at different markets, I guess. I see overpriced ones sitting, yes.
Yeah.
Overpriced, they're sitting. But market price, they're still selling.
Yeah.
The ones I'm looking at.
Yeah, I mean, it's you're limiting your buyer pool.
Duplexes... Yes, they are sitting, because that is an owner-occupied property. That is not an investment property.
Right.
Duplexes are owner-occupied properties. No investor is going to go and get a duplex at market rent, at market value. If it's 70% below market value, yes, that's a deal an investor would buy.
Right.
But an investor is not going to buy a duplex because it doesn't cash flow, number one. And and that's the whole thing. It doesn't cash flow.
Right.
And it won't.
Right.
But duplexes are owner-occupied properties. That owner is buying that to reduce their monthly spend on their housing.
Yeah.
So instead of buying a house and paying $3,000 a month, they can buy a duplex and pay $1,800 a month.
Right.
Or $1,500.
Yeah. Yeah.
Well, that's a lot easier, and then you're kind of stepping in the right direction for home ownership. Whether maybe your end goal is to buy that single family home. Well, you know what? I'd rather not rent for the next 3 years while I'm saving up and finding the right property and advancing in my job and getting higher pay. But I could own an asset. It's going to grow in value. I'm going to pay what I'd pay in rent anyways somewhere. And I own this thing.
Right. Yeah, exactly. And it's actually pretty crazy too, like the difference between, I have a duplex buyer and that's looking in like Billerica and Woburn, and that market is, duplexes are going in 2 days.
Yeah.
It's crazy where you look at the two different, the northern Mass to southern New Hampshire market. Like, I mean, people are still going way over. They're waiving everything, 10% EMD. Like, it's crazy how this is all, like, the difference in markets. And yeah, we're, our market's still hot relatively to, still being a seller's market, whether buyers want to think that or not. But like Northern Mass, it's like, gee, this is crazy.
Yeah,
this is bananas what you have to do.
And the reason I say that, I'm not seeing multifamily slow down 3 units and above, 3 to 4 or even above, is because there's still a ton of investor money out there. Again, we're talking investor versus owner occupied. Owner-occupied,
very different markets.
Yeah. So that's why I say the duplexes. Maybe that's what you're referring to.
But that's probably why, because we're telling people now, not telling them not to buy 3 to 4 units, but it's, hey,
you can't.
The likelihood is very low. This is probably where you're going to want to go. So we're looking more at the 2-unit market in general, and we see a bunch of them. So it's like, oh, they must be sitting.
Right. Well, yes, they are. 'Cause that's just like an owner-occupant, and that pool of buyers is different. Yeah,
right.
Exactly.
Right. And it does take a very specific buyer that wants to do that. That still wants to, not have their mortgage completely paid for, which is generally why you're buying a multi. Yeah. And then, they're still eating some of the mortgage payment, but, they would rather, like you said, they'd rather do that than rent. But yeah, self-sufficiency is causing some pretty big issues that I'm over. I'm not going to lie.
Yeah.
It's like you don't want to tell somebody that's impossible, but I mean, it's a very, very low probability that self-sufficiency works. And even if you feel like you got the deal of a century, like lease agreements could literally kill that. And it's like, it's wild. It really is.
So if mortgage rates, so obviously the FHA owner occupy for multifamily, the rates are below 6, which is better than conventional and like investment properties.
Yep.
What would they have to come down to? Well, I think you kind of already said it. What would they have to come down to make it work?
A lot of the times, right? Well, yes, it depends on how far below you are, but generally, right now, like low 5s is where we're seeing. Even at lower lease agreements, low 5s to high 4s is where
we'll make it work.
Where it would need to be to make it work. just because of the lease agreements. And it's super frustrating because we're giving buyers these numbers of payments before they're even putting the offer in. And they're seeing, oh my God, I'm going to either live for free or very little out of pocket expense. Like, this is an awesome buy. And then it's like, oh, sorry. Nope. It's not. Just kidding.
Unbelievable.
Yeah. So it's a super tricky thing that we're getting by, but I mean, it's going to turn eventually. It's just, unfortunately, like, I'd rather be very realistic about the situation with buyers and not give them this false hope. It's like, it's probably not going to happen. I hate to break it to you, but it's probably not going to happen.
Right.
Like you said, like, as sellers, like, you got to be aware of it. Like, I think this video is even for sellers. Like, be very aware if you're going to accept an FHA offer with a 3 to 4 unit. Like, I don't like saying that, but it's just the reality of the situation. You have to really make sure your ducks are in a row.
And it's not you or the underwriters or me, the agent, or the sellers or the buyers. It's FHA.
It's just FHA. It's the government guideline.
They're not discriminating against anybody.
Right.
I'm not going to say it, but the FHA is. I said it. Yeah, like, they're just making it difficult.
Right.
Everything the FHA buyers went through with, when there was 3% interest rates and, but there was like
impossible to buy a house.
There was 40 offers with conventional. Well, sorry.
Yeah.
And they're stronger. That was what we just went through. Now we're going through this with FHA for multifamily buyers.
I remember that time. I only got one FHA offer accepted in like a year period. And it was because they were commissioned employees. So they were 1 year commission. So I was like, okay, like, you're an unbelievable buyer. So I had to relay that to the list agent without obviously giving away all the info. But hey, this is not your typical FHA buyer. I know it makes, like, FHA has the stigma right now, but like, without giving you everything, like, we're fine. Like, it's just one of those things. Like, that was the only way you can make it. Like, if you didn't have that to really show them or explain to them, like, this is the reason we're going FHA, like, you just wasn't going to happen. And I mean, right now at multifamilies, it seems like it's going to stay that way. But
until rates dip or people that are selling are selling with higher rents in their pocket.
And I think New Hampshire housing, I'm not overly familiar with New Hampshire housing, I will admit that, but I don't think they have any like 5% down multifamily programs. I'm not 100% sure on that. Conventional does, but like we talked about before this, like, it's a very particular buyer that is fitting into that because the income limits are very tight and you really need to be right at the top of that income limit with no debt. That's pretty much it to be able to qualify for.
So you have no debt and probably
you make like 90 to 100 grand. Like, that's what's going to fit in that buyer pool.
People that typically make 90 to 100 grand have debt because they have lifestyle creep.
Have some sort of debt. Yes.
Because if I at a W-2 job can make 90 to 100 grand, I'm buying a car.
Yeah.
I'm buying this.
Honestly, like, you moved up in your job, you graduated school 5 years ago. You probably got some student loans still, unless you buckled down and just wiped the thing off.
Which is rare. Unfortunately, is rare.
Right. Right. And we see it. I mean, I've seen it where people stopped shopping with me a year ago and then came back and their student loans were gone. And I was like, oh, that helps tremendously.
Yeah.
And I applaud people for it, but it's like, okay, like, that's a one in...
Buckle down and make the right moves.
Right. That's a 1 in like 100,000 chance of unfortunately that happening. But yeah, no, it's definitely, like, conventional stuff. I know Mass Housing has a 5% down program, which is why I think mass multifamilies is still going crazy because you can, and it's not even a down payment assistance program. It's just the qualifying ratios are easier. They don't have self-sufficiency. Like, they don't have all of these things. So it is easier on mass. I think that's why the mass market is still going bananas with the multifamilies, even the duplexes, like, because people are like, I only have to put 5% down, deal. And there's no income limits, deal.
I'm in.
Deal. Like, that's kind of where, the income limits are like, mass income's higher. So you probably talking about $160, $170 as the income limit. Like, you're looking at a very qualified buyer that's probably, has stepped up in their career, has paid down debt. Like, it's a very different thing when you get up there. But yeah, it's super unfortunate. I really wish they would at least do something to change the guideline of it. I get why it's there, because if you have a first-time home buyer that's never paid a mortgage, you want to make sure that there is something in place there. But you got to make sure, you got to still make it possible for people to buy the house.
Right.
Like, and I think that's the thing that people need to realize is there's a place for it.
Well, they raised interest rates for second homes and investor buyers to be more in line, to make it tougher. First of all,
yeah, because they knew everyone was buying the second home to Airbnb it.
Yeah, or the multifamily, right? Like to make money off of it. So they made it harder by raising those rates, and now they're just making it harder for FHA buyers. Where's the happy medium?
Right.
Now you've just got your regular conventional 10 or 15% down.
Yeah, depending
15,
depending on the unit. So 2 units is 15, 3 to 4 units generally is 25.
For owner
occupied, yeah.
Really?
Oh yeah.
So they're making it harder for
Fannie and Freddie. Oh yeah.
What is going on?
Yeah.
What happened with 5 and 10% down conventional owner occupied?
Oh yeah, that's 10%. That's not there anymore. But like we talked about, the 5% is, but
you got to be a specific.
Yeah, you got to be a specific person. But I think it's also important to note that self-sufficiency is there for a reason. Yeah. It's not just this thing that FHA wants to do to kill loans. Right. And it's frustrating for buyers. But you got to realize, think about it. If you were, this is how I describe it to buyers a lot. If you're lending money and you have a first-time home buyer that's never made a mortgage payment, that's relying on other people to pay the mortgage so they can afford it,
who's never operated a
rental property
as well.
We're talking about a lot of variables here to allow that person to make the mortgage payment.
A lot of risk for that lender.
Right. And mind you, with the rents being counted into income, we are still pushing a 45 to 50% debt to income ratio. Like, if one of those tenants doesn't pay, we could be talking about a real disaster here, right? So, from the government perspective, or you're looking at it from you lending perspective, you want to make sure that the ducks are in a row. It's still ridiculous. With that being said, I'm not vouching for it. I'm just saying that they're, why it's there. Because I think that's important to note.
Yeah.
Like, we've kind of trashed all over it and, how it's killing a lot of deals. It does have a place. It's just, I think the guideline, the system for it needs to change. That's, I think, the key takeaway from my perspective anyway, from the lending perspective. I get it. Change it.
Yeah, exactly. Or not necessarily change it, but just be flexible with it, or the hard and fast rule. Maybe you can put in a 10% buffer or something. Along those lines.
Something. Yeah. Even like just applying. Even simply like, hey, if I give you the lease agreement signed by the tenant of the new buyer that's buying it for what this rent's going to be, can we make that work? Like, I personally don't understand why that wouldn't work, because as soon as you close the loan, that's the new lease. Right. So like at the time of the loan being closed, like technically that's what the lease would be. Like, I don't understand why you wouldn't be able to do that. I get it. Maybe they're afraid of people going back to the old leases and just doing it to make a loan work. But if something's $700, $800 below market value, like that seems a little unreasonable to assume that the new person buying it at the higher value with the higher interest rate is going to keep it there.
Keep that. Right? Yeah, 'cause they're not.
Right.
They're not.
So, it's just one of those things. But in good news, rates are stabilizing. I think, they're stabilizing still. I know we've said it a lot, but everything's starting to come back to normal a little bit in terms of none of these massive ebbs and flows.
No.
The market's starting to stabilize. Good things are still happening. It's just self-sufficiency is not one.
Yeah, I think 2023 is going to be this kind of like flat,
which is relieving.
Road.
Oh my God, it's so relieving.
And what I'm seeing, when I'm talking with my buyers, is that they're scared because they didn't know what to expect in the next week or the next month for interest rates. Because if you get locked into a property, it doesn't mean you lock your interest rate necessarily, but so it's always changing. So you could be shopping one week, and then the next week you're still shopping, and the interest rate's different. You're like, well, now it doesn't work, or that was happening last year. Now at least we're going to be, hey, there's that 6 to 6.5 flow of just, it's going to be steady like that.
Right.
So I think the stability will help ease a lot of people's nerves.
Right. Oh, definitely.
Going forward. Definitely. We're going to have a busy market.
Yeah. Yeah. And think about it, people hate change. So when things don't change, they're more comfortable. Let's dive in and buy a house,
yeah.
which means more demand with low supply, which house values are going to rise.
Right. Yeah, exactly. There's still a ton of demand. There's still a ton of money on the side there, especially investor pockets and everybody really, because they printed more money in the last 2 years than they have in the previous 200 years. More 2 years more than the last 200 together.
Right.
So there's a lot of money out there, and not everybody has that money, right? Not everybody's sitting on that money. I get that, but
or just willing to spend it. Maybe they are just flat out sitting on it because they don't know what's coming with the economy and things.
Well, because they think a bubble's going to burst.
Yeah,
it's not going to burst, people.
Right.
This isn't 2008.
Right.
Get the recency bias out of your head.
Yeah, it's not even 01. I think didn't the housing bubble, or it was like a smaller kind of dip back in like 2000 to 01 or something like that.
Yep.
I guess.
The technology, the bubble there.
Yeah. It's just not the same. And honestly, I think if it was going to happen, we would have already seen it when inflation was 9%. Or
it was supposed to happen in 2019.
Right.
Honestly, if you look at the chart, I posted on my Facebook page, Racine Realty Team or Rich J. Racine, in the story, and it is actually on my post, on my feed. If you watch the graph, the 2008 bubble, it shows it going up, and then it comes down pretty sharply. But there's a lot of things behind the scenes that cause that.
Yeah.
So, but then if you watch the graph as it goes up, and it goes 2019, and then it starts to come down, and then we hit 2020, and it shoots right up. So it was coming down. It wasn't coming down sharply, but it was coming down.
But it was starting to correct.
Right. It was starting to correct, and then it shot way up, way past anything it's ever been.
Yeah.
But it doesn't mean it's going to come back down to 2019 levels, like home prices.
Right.
Because that's what the graph shows. It shows home prices.
Right.
So, home prices are going up, coming down slowly, and we won't see 2019 prices again, which would be like a 30% difference.
And you don't want to see 2019 prices again, just like you don't want to see 2019 S&P 500 prices, because that means we are screwed.
Yeah.
I was going to say another word. We're screwed.
Yeah, exactly. So will it correct 10%? Sure. Will there be homes that people don't want to buy? Yes, of course.
Right.
But if you wouldn't buy that home, then other people wouldn't buy that home. Don't use it as a comparison for the whole market. Yeah. There are homes that people don't want to buy because of the interest rate.
Well, it's kind of like I just did with duplexes and generalized it as multifamilies, right?
Yeah.
Like I'm saying, multifamilies are sitting. It's like, no. Duplexes are sitting. Right?
Yes.
So it's very different. Or it's like, houses in Manchester are sitting, where it's like, no, the fixer upper is
the crappy house that nobody really wants to get into.
Terrible area, right? Is sitting.
Yeah, and it's priced for an owner-occupied person, not an investor person.
Right.
Because an investor's going to look at it, I need 70% less than fair market value once it's fixed up.
Right.
That's a number they'll buy it at all day long.
Right.
But when they're trying to get close to market value, well, an investor's not looking at it. An owner-occupied doesn't want to deal with the headache.
Right, but that doesn't mean the houses are sitting.
It doesn't mean all houses are sitting. Yeah, it just means that particular crap hole is sitting.
Right.
So there'll be those one-offs. There'll be those different ones that just don't sell. But the market in general is still on an upward trend. I mean, 2022, even with all the
inflation,
I was going to say velocity, but
the increase in price.
Yeah, exactly. All the turmoil that was going on with interest rates, we still saw a 10% increase. This is New Hampshire. We still saw a 10% increase appreciation in home values.
Right.
No, it wasn't 20 or 30 like the years before, but we still saw it. So the demand's still there.
Even if we see 5% this year. In a general 4% in a general market, like that's normal.
That's normal.
It's a normal. That's a normal appreciating market,
right? And we've still got less than 6 months inventory on the market available, and 6 months is your kind of barometer for if we're
sellers
at 6
market
months,
versus buyers.
Yeah, that's right in the middle. We're right there, but we're at like 4 months of inventory in the market, so we're still in a seller's market.
Right. I think it's just crazy too because. Not to go down a rabbit hole, but like for instance, Salem is so different than Manchester. Mm-hmm. Like it's the house prices where Salem's house prices are in that range where 6% rates are hurting it.
Yep.
Or I'd say probably 70% of the house prices are in that range.
Salem, I heard Northern Mass, but I got you.
But like we talked about, like there's a house that was like 2 streets down from me that was a little bit of a needed some love. We'll put it that way. It needed some love, but it was priced under $400. Went in 2 days. There's a house 2 to 3 streets to the other direction of me that's fully updated, very well kept, great yard, fenced in. It's in the mid 5s. It's been sitting, and I'm like, this doesn't
Doesn't make sense.
Doesn't make
That's
any
a beautiful
sense.
house.
Right. But it's the payment. It's everything in there. So yeah, I mean, if you need help with, deciding maybe what areas are right for you, maybe is FHA 3 units the right thing for me? Reach out to me, reach out to Rich. We're here to guide you and just keep it very honest with you and what's happening in the market. And it may seem deflating, but we can always find and look at possibly other paths for you to get into multifamily home ownership, whatever it is that you want to get into. Like, tell us. We'll keep it very honest.
Yeah, we'll strategize, right? The strategy behind it all. And where can people reach out, find you?
They can find me. Well, find me on Instagram. I believe it's M_McDonaldLO. I just changed it, so I'm got to remember exactly what it is now. You can find me on Facebook, Matt McDonald. Email mmcdonald@pmlhomeloans.com. My phone number will be below. So all the areas. What about you?
Very good.
Where can I find you?
Rich at racinerealtyteam.com for email. Go to YouTube at Racine Realty Team. Subscribe there. Take a look at the videos. Some good content on there. Some of the stuff from here and some other things that I've done. And you can go on Facebook, Instagram, Racine Realty Team.
Yeah, awesome. And then find nhhomesforsale.com. Yes. You can find the both of us there. Look at properties, like we always say. Direct contact with us, asking us questions, getting set up, getting strategizing, maybe getting pre-approved, maybe setting up showings for houses. Like, you can do everything on there. It's a great one-stop shop. So make sure you visit there. Reach out to us if you have any questions, and we'd love to help you out. And that, for the 28th time, is why money matters.